All right. Good morning, good afternoon, good evening, depending on what part of the world you're watching this from. I've got Nash Paradise, the Lone Wizard, with me. I'm Matt Gouget, Matt, the mortgage guy. Our Monday market update, in my opinion, serves a few purposes. We want to talk, deep enough and detailed enough to where we're going to add value to loan officers and real estate agents watching. I'm going to try to keep it simple so that your average consumer can watch and understand what's going on in the world of real estate, what's going on in the world of mortgage and interest rates. So without further ado, welcome, Mr. Nash Paradise.
Thank you, sir. I am not going to keep it simple. I'm here for the high level numbers nerd crunch because that's a good time for me and it's just who I am. It's what I do. So I appreciate your balance out here. Let's get right into this week's recap. So last week we got together, talked about couple big movers, couple big bits of news that were coming out. Wednesday last week, we had the month-over-month core CPI for November, as well as the year-over-year core CPI. What we talked about is these numbers were a little tricky because in November, year-over-year, there's not a lot of room. There's not a ton of money moving. So, no one really cares a whole lot. And that's exactly what we saw. We came in, hit estimates at 0.3% on the month-to-month. The year-over-year stayed consistent at 3.3%. Not much movement there. Thursday, where it was the jobs day, we got jobless claims came in a little bit higher at 242,000 off of a 220 projection and a previous to 224. It's still consistent enough that no real activity at that point. Continued claims, same thing, 1886 versus 1880 on the projection. Previous months was 1871. So we're all in that wheelhouse. Nothing real exciting. The core producer prices year over year went up a little bit from 3.1 last month to 3.4 this month and a projection of 3.2. Now they did go back and amend the previous month's figure from 3.1 to 3.4. So while it doesn't create any real material data shift, there was a little bit of activity on Thursday after that. All in all, rates got worse last week. No real news, not necessarily data driven. It's not always about, data driving the markets. Most analysts and experts that I've seen, their opinion is somewhere in between, I don't know. And, European bonds having a rough go at it right now, but the US bonds took it harder than Euro bonds. So the only other good explanation is just a lack of liquidity and people figuring out their end of year positioning, which doesn't help us a whole lot because you can't really anticipate what the end of year positioning is going to be. Any thoughts on last week's activity, Mr. Gucci?
Yeah, as you said, rates got worse. And so the too long didn't read version of what Nash just bestowed upon us is if inflation isn't coming down and we don't see any real issues in the job market, the Fed has no real reason or justification to cut the Fed funds rate, which eventually helps mortgage rates come down. So it's going to be an interesting week because the Fed's meeting this week. Every other meeting, they do their dot plot. I'm going to do a video too on like what exactly is a dot plot. What's a summary of projections? It's the Fed saying, here's what we expect to happen in 2025. They get, a bunch of different Fed presidents plotting. Hey, I think there's going to be 4 rate cuts. I think there's going to be 3, or I think there's going to be 5. And so it'll be interesting to see that. What a lot of people think is that that dot plot is going to show them starting to say, hey, maybe we're only going to have 3 rate cuts in 2025. That's going to be bad for rates. If the Fed says, because of the data they've seen since the last dot plot came out 12 weeks ago, hey, 25 might not be as aggressive on rate cuts as we originally thought. And that's going to drive mortgage rates higher. And so, it's not really good news, but it's what the smart people I listen to are saying. And so we're going to provide that to you here. Not good news in the fact that mortgage rates are, going to come down any significant way anytime soon. We can talk later on how that affects the real estate market, because I think there's some good news embedded in here. I'll save it for you for later.
Yep. Speaking of dot plots, let's get right into the charts here and take a look at, the week over week interest rate movement. Now, this chart looked a whole lot nicer last week when we were going over. We were at the very bottom of that little drop where we saw the overnight average interest rate get down to something in the range of, I think, 6.68, 6.69, something like that. And here we are today, 6.95. So as we discussed last week, no real interesting news, but rates are shooting back up a little bit. And like you said, this week is a big week to see what's going on. Any thoughts on the rate movements that we're reporting right now?
Yeah, I mean, this last week certainly wasn't friendly for rates. And anytime there's a move in the trajectory, I think it either dampens the spirit of the average home buyer. It certainly has an effect on demand. And right now, being December, there's not a ton of demand in the market. The only thing that's keeping housing prices, propped up and still some upward pressure on home prices, there's no inventory. But we'll see it in our conversations, and it'll take some time to kind of seep into the data of mortgage applications. But there's at least a little bit of a difference between what people feel as we're headed down and we're 6.7 versus we're headed back up and we're approaching 7% on the 30-year fixed.
I think it's the LOs. You're talking about the temperature of home buyers. Well, they don't know yet. It's a lot of loan originators and sometimes real estate agents who are plugged into this who are like, oh, well, now we're headed back up. And then, that's going to convey. It's tough to talk to someone that you talked to early last week when you're like, oh, yeah, hey, rates have gone down a little bit. Let's get excited. Okay, let's go run some numbers on this house. And now it's like, oh, yeah, by the way, they're up about 0.25% from last week.
Let me interject here real quick too, because you're 100% right. You talk to the average consumer, they only are focused on rates when they're talking to you in the specific moment. So literally 2 in contract on Friday, 1 in contract on Saturday. Both of those borrowers, last time we looked, was before things went down to 6.75. So that little dip that we all see on the chart, they didn't realize it happened. We priced it. It's almost exactly the same as it was, let's say, 2 weeks ago. And so it's like, okay, we're going to pay a 0.5 point for 6.99. That's what we're doing today. And so I think you're probably right. It's more psychological for the people that are paying attention to it every day versus a buyer who's like, hey, it's September 25th. What's it look like? Okay, here's my options. Hey, it's October 17th. Just checking in. We still haven't found anything. What's it look like? And they're probably looking at rates once or twice a month versus 17 times a day, like your average mortgage nerd.
Yeah, if that. I mean, a lot of times they don't even know what the rate is until they ask about it. And that's where, your impression is their reality. So the psyche of the salesperson is very, very important, because here's the trap that you can run into, especially in a week like this. You feel like they've gone up. There's that semi-logical part of a loan officer that says, oh, well, they've got room to go back down. The 10-year treasury bond's got room to move. It's kicking at 440 right now. We had a lot of resistance at 417. So, I mean, man, that's like 23 basis points. I could get 0.25% back. But as we get into what's happening this week, that could be a very, very dangerous play. But before we get there, let's go through the slides a little bit and take a look, because we have a huge meeting. Oh, my goodness. Look at these numbers. We got 2 days here. Wednesday is going to be the Fed meeting. And the dot consensus here is what I would call a consensus. What does this mean, Gucci?
97% chance that we're getting a Fed rate cut. Here's something that people need to listen to. If you don't listen to anything else, listen to this. I predict, and Nash will either confirm or deny, that most people, like you said, the average consumer is not really paying attention. They don't really understand how all of it works. The Fed is cutting interest rates. Headlines will even lead with the Fed is cutting interest rates. They're going to cut this week and mortgage rates will get worse. One of the reasons they're going to get worse is because of the dot plot. Another reason is everything else that's coming in, economically, as far as data goes, that really drives mortgage bonds and mortgage interest rates has nothing to do with this, because this is a foregone conclusion and been baked into rates for months. Now it's absolutely certain, 97% at least, that we're going to have a 25 basis point Fed rate cut does not equal mortgage interest rate cut. And so people are going to be okey doked just like they were in September.
Yeah, 100% agree with you. The stuff that I follow, the experts that I watch, they've already posted their projection now, updated this morning to a 0.25% Fed rate decision on Wednesday. That is the overwhelming consensus. So, I can say with confidence we're going to see a cut in 2 days. It's going to be interesting, hearing the press conference after that move to see that what is said is going to have a bigger impact on what is being done, because what is being done is expected. The rest of the stuff coming out, and I'll talk about what's expected this week, what we have going on. But I think it is a foregone conclusion here that, the end of 2024 is going to finish with one rate cut, which, like you said earlier, talking about the number of cuts that we should expect in 2025, that's impacted by the fact that we have one here at the very last Fed meeting in 2024. So let's look a little bit at the January projection on that next meeting. Again, another one at the end, January 29th. We've been fairly consistent. Both you and I have agreed, at least in part, that we only anticipate one rate cut between the December and the January meeting. This chart shows 83% in agreement with that. Is that still your analysis and projection, Matt?
Yeah, for sure. Once, it's interesting to me that it's still a 97% cut, maybe because they've been on it for so long. I think that they could have justification for not cutting in December, but I think they're going to do that knowing full well that once they click down, 25 basis points, they're going to hold pat. And who knows, like this 81% for January, the first few meetings into 2025, I wouldn't be surprised if we go, January, March, May, and we don't see much movement beyond the 25 basis points they're going to do this week.
Agreed. Let's take a look and see what the next projection looks like, because I believe March 19th is that next meeting. And it seems like we're still a bit of a mixed bag here, although about 62% are saying at least one more cut by that meeting. I've said this before, still too soon to tell. We're gonna need to see the reactions after the December cut, but then we're getting a new president. We're getting a lot of new things happening in January of 2025. So this is going to be mostly data driven, and this is just a big set of anticipated events and expectations. I always said March was too far away, but I do think it's interesting the way that this chart has changed a little bit over time. It's not super aggressive on that, that 52.7% group saying that we're going to have a second cut. We'll see what this looks like in a few weeks. I wouldn't be surprised if we see this shift a little bit towards possibly not doing a cut in March, but because there's so much time between the December 18th cut and the March 19th meeting, who really knows?
Yeah, you know what I'm interested, because I've looked at like the inflation numbers. January and February of 24 are super high, so that when we get the new numbers that replace those, that's going to help that inflation number, at least on paper, look a lot better. I wonder if that CPI number in March, that will be February's number, that comes out before the Fed meeting. Do you know that?
Yeah, it should.
Okay. Yeah. Cause that's another X factor too, which we don't know yet, because that's not out yet, but things like that come up between now and then are going to have a impact on it. And, the Fed will say it in every single meeting. If you want surety on anything, Jerome Powell will say something to the extent of, we're data dependent. We'll wait and see, and we'll make our decisions based on data.
100%. So that they'll do it for talking about the stuff that we have no idea and is likely to change. But this is the first time that we've had one of these discussions, Monday Market Update, where we can basically say with certainty that, hey, we are seeing a Fed rate cut on December 18th. So market, save it, queue us up for that. Let's move on into the economic calendar for this week. Let's see. So we've already been hit today with S&P Global Services PMI. It came in a good bit over estimate, which is not great, but it did pull bonds back a little bit. So not awesome for interest rates. It's been fairly flat today, but again, we're down 80 basis points since last week, which is reflected in that 0.25% increase. Other stuff coming out this week that's important. There is a 20-year bond auction tomorrow, which will be neat. Retail sales will come out, should have a little bit of growth. Nothing crazy is anticipated there, but Wednesday is the day. We've got a lot of neat stuff. You're going to have all the MBA purchase data, the MBA refi index. So we're going to be able to see what's going on in the housing market. Housing starts month over month. Housing starts changed. It looks like we're anticipating a small drop there. Building permits and that change should be relatively flat. Fed rate decision at 2 p.m. Already hitting us with a 4.5 expectation on there. So we're going to see a lot more of the projections coming out after that. Press conference at 2:30. That'll be big. But then after all that, man, we got a packed Thursday. Jobless claims, Philly Fed, continued claims, GDP in Q3, GDP final sales, core PCE prices for Q3. There's a bunch of stuff going on Thursday. Don't sleep on Thursday. It's going to be a pretty big day. And then, man, PCE numbers on Friday, core PCE month over month and year over year. We've got projections, which I don't like, but the projections are for the month over month November PCE to actually drop from 0.3% to 0.2%, and the PCE inflation year over year to go up a hair from a previous 2.8% up to 2.9%. So having some mixed data like that, unlikely to help anything. In fact, this entire week is just like one big landmine where we could really see rates go up a good bit depending on what happens, even if it's a lot of no news and just hitting expectations. But let me get your thoughts on all that.
Yeah, I think what people need to hear is the old saying, if you like it, lock it. It is way too volatile and way too much like danger to the upside as far as mortgage interest rates go to try to time anything. And I think for whatever reason, like people are optimistic, probably overly optimistic, loan officers included, where take a look at the rate stack. It's going to cost me this much for 6.99. Do I want to pay this much for 6.625? Lock it once it's in contract. And you shouldn't really think about it beyond that. If you've got a longer escrow period, your loan advisor could advise if there's opportunity for a float down, but it's likely not going to happen. And I've seen it burn too many people too many times where, like, what are you hoping for? You hoping that the rate you locked is $600 less expensive a week and a half from now versus like, oh my gosh, I just cost myself 0.25% on my rate. Now I'm paying an extra $110 a month for the life of this loan. Don't let that be you if you're a consumer. If you're a loan officer, do your clients a favor and go through the different options today. And if you've got a contract, find the option that works best for your client. Have your client lock that interest rate as soon as possible. In 10 years of doing this and a couple thousand loans closed, like that's just the standard now. It's just, if you like it, lock it.
Yeah, I'm definitely calling on a lock alert as well for the same reasoning. We have kind of a cheat code here being mortgage brokers. If everything is fine, everything works out well, or we even get a nice little boost and pricing gets a whole lot better, we've got a combination of elements, float downs, relocking with another lender. It's good to be big and it's good to be flexible. So it's kind of cheating a little bit, and hey, it's why we like this broker channel. But I'm definitely going to be taking that approach, liking what I've got right now. But again, as we talked about earlier, the trap here is, things got a lot worse from last week. Maybe I should wait and see what happens. It's just too dangerous of a week. Yeah, it could get better. Like, I'm not saying I expect it to go higher. I'm just saying that the combination of elements, usually the last 3 Fed rate cuts we've had, interest rates have spiked after that. It has not been good for the mortgage market. And until the mortgage market starts responding in a favorable way, I mean, we need the bond market to like it. And, the year-end positioning, the lack of liquidity that we've had, it's just this stuff does not bode well for bonds to make a rally. And they could, cool, but there's also a good chance it goes the other way. So just battling the loan officer narrative of, well, it went up pretty quickly, so it could go down too, past performance doesn't necessarily mean it's indicative of, future expectations here. So if you like it, lock it, move on. And if you got to make a change after the fact, cool. Work with a professional mortgage broker. You'll have that flexibility.
I love it, man. You know what I want to talk about if you don't have other, nerd stuff to talk about numbers wise?
No, let's hear it, because the nerd stuff's basically done at this point.
All right. Nerd stuff. What I think is really interesting, and I love to talk about, and like, we're in different markets, so it's good to hear what's going on in your neck of the woods in Texas as well. I like stories from the streets, tales of what's going on. All of this interest rate talk is, for some people, boring. And some people, it's like, man, rates are high. It bums them out. I've got so many different stories of buyers who are winning. And I remind them 7.25, 7.125, whatever you're in today, like there's very little chance you're going to ride that thing for 30 years. So don't be focused on the interest rate. In the neighborhood that I've lived in for 44 years, great neighborhood, 10 minutes to downtown, next to the freeway, close to a university if it ever becomes a rental property. There's all these good things about this neighborhood. Like in the spring, you wouldn't have found any house that's standing under 500,000. A client of mine just got into contract, a 3-bedroom, 2-bath, in great shape. It's going to make a great rental for 465,000. Another client is getting one in contract down the street. Probably going to be an even lesser price. And so I see clients continuing to win in this market who don't just look at it and go, rates are higher, I'm done, right? They're out there deal hunting. And I think that that's probably a lot of markets across the country. You might pay 10 or 15% less than the spring price, whether that's spring of 24, or if you look back to like spring of 22, where a lot of markets kind of peaked. So I'm interested to hear, like, you're working in a bunch of different parts of Texas. What are you guys seeing out there? Are you seeing buyers negotiate credits, get price discounts?
We are. It's shocking to hear you say a $465,000 home could make a future rental. Y'all's expenses out there are just wild. I don't. Yeah, no, that's ridiculous. I mean, some of my wins this week are funny. This veteran family thought that they were only going to be approved for about $330K. Turns out, because there's a 100% disability rating, they don't pay any property taxes in the state of Texas. They can hit their goals all the way up to about $440,000, which is really exciting. It's definitely the right thing for this veteran couple. And they both served, and they both have disability rating. I mean, they put their bodies on the line for our freedom. And it's really awesome to see that they're going to be able to get some awesome value here. Even when they were looking up to 330, 350K, they're finding properties. There's stuff out there. I mean, it's a great spot for a first-time home buyer, and it's over our entry-level pricing. Our entry-level pricing here in North Texas, I mean, you can find stuff in the mid 200s, upper 200s, but it's not necessarily going to be what you're going to want long-term. So it is nice to be able to press that a little bit, get that affordability out there. So we're seeing wins like that. We're also seeing a bunch of appraisals come in higher, just because there are fewer buyers that can compete when we do have homes in that 400, 450 range without a huge down payment. And our property taxes are a little rough out here. No state tax, which is nice, but you could buy a $400,000 home and absolutely have a $3,500 monthly payment. That's completely in line. And I know that's a lot higher than a lot of the rest of the country, but that $400,000 home, I just got an appraisal in the other day at 428 on a 400K purchase price. And I'm like, yeah, it stinks to pay an extra $400 or $500 a month over where we would like to be, but $25,000, $30,000 in equity just to start. And we start looking at, the differences of buying versus renting and all that money that's getting tossed around. I'm like, yeah, there's some wins to be had out here. They're fewer than they used to be, but the wins feel really good, because that these people wouldn't be able to make these same wins in a market where they're having to compete with a bunch of other buyers.
Yeah. And that's the thing is, for buyers, there's no perfect market where you have great prices, great rates, and a great amount of, negotiability, if that's a word. And so you got to pick your hard. Buying a house can be looked at as hard in any market. It wasn't easy in August of 21 to go up against 37 offers and have to offer 40,000 above the appraised price, waive your inspection contingency, all the crazy stuff that I saw. And, some of it honestly wasn't, recommending people. Then they find they've got foundation issues and an $80,000 problem on their hands. But that's hard right now. People like, hey, prices haven't really come down. Prices are stable and high, and the mortgage interest rates are high. Well, the good news is go out there and get a credit, get $20,000 off the purchase price. Have the seller fund a buy down where you get a lower interest rate for the first couple of years, and you win in that way. A lot of people, unfortunately, in my opinion, are waiting for some perfect storm of lower interest rates, lower prices, and think they're not going to be competing against everybody and their mama who's sitting on the sidelines hoping for the same thing. It's going to be a tougher market competition wise if and when mortgage interest rates come down, because we know that drives demand.
So, I mean, for me as a college dropout, public school educated guy, it sounds like what you're saying is that there is some sort of correlation between supply and demand.
Yeah, I think there is a little. There's some rule about supply and demand. I think like they
Oh,
teach
yeah.
it in econ class. I might have been sleeping.
I don't know. I think I hit that in ninth grade economics. But basically, if I'm hearing you right, we've got lower supply, we've got some lower demand, and that's creating an interesting dynamic where a buyer has an advantage right now. The price point matters, but I mean, especially in my area where 600 to 900K is considered like a third level, fourth level luxury type home in a lot of neighborhoods, or it's, a very hard to get sought after area. Those are the homes that we've seen massive price reductions. I mean, 50K off, another 25K off, another 10K off. It's not that people don't want the home. Usually, I tell sellers that like, hey, it's always about price. At a certain price, someone's going to be willing to pay. But right now, it doesn't really matter what that price is. You got to find a buyer. You got to find the right buyer. And there's more homes that need the right buyer now than there were in previous markets. Previous markets, it's like there's so much inventory. There's so many buyers that like, yeah, I'll just make this work. But a lot of sellers and a lot of listing agents I'm talking to, it's like, yeah, it's going to take 90 to 120 days to sell this home, because not that there's anything wrong with it, not that it's priced poorly. You're just waiting for that one out of one person. And if you are that one out of one person, you got a lot of leverage. And as long as there's not a second person that is also your type of needs, you can go 20 grand under. You can ask for that 10 grand in concessions, 15 grand, ask for that seller paid buy down. Put yourself in position to be able to make the most out of your offer. Yeah, you're taking 2 steps backwards on the interest rate, but can you take 4 steps forward on the eventual equity in the property? Absolutely.
Yeah, for sure. So if you missed that, guys, there's opportunity out there. It's always great talking to you, brother. We'll be back next week to talk about all this stuff that's happening this week. Like you talked about economically, we'll be back to tell people, I think we told you so. The Fed cut the Fed funds rate, but mortgage rates got 40 basis points worse this week. We'll see how that prediction pans out. Final thoughts.
Yeah, man, it's all about what the Fed next week. And I'd like to say we're going to come back next week, talk about everything that happened this week, everything that went on with the Fed. Will be a lot of reactionary, a lot of knee-jerk Monday morning quarterback stuff, which will be fun. I bet we come in next week and say, hey, everything was flat. Good news. The sky didn't fall. And I'm only throwing that out there because it's what I want to happen, not because it's what I believe will happen. Your guess is as good as mine. So final thought, lock it if you like it. Make sure you're being transparent with your partners. Tell them about the sense of urgency right now, because there is a lot of, variability in what could happen this week. Do what's best for your people. Make sure that this correct message is going to the right people. You could be costing someone tens of thousands of dollars in eventual net worth not to get this information out to the people who need it.
Love it, man. See you next week, brother.
Take care, homie.